Hey everyone, and welcome back to another dividend portfolio update. Today we're going to be talking about a couple things, but first and foremost, we are here on my Dividend Dentist portfolio, where we're going to talk about my current value, some of the things I've been investing in, as well as talking a little bit about my passive income I want to make with over $1,000 a month in dividends. Now, there's a couple different things that we want to go over, but before we do that, first thing I want to mention is that currently we are using M1 Finance, which is this investing platform right over here. You can find the link to it in the show notes down below if you're interested in checking it out. It's what I personally love to use. Clicking that link does help support out the channel, so if you want to do that, I much appreciate it. Now, what we're going to do is talk about a few different things and then kind of go over some of my decisions and why I want to make them. So hopefully it helps you out when you go through this process as well. So let's kind of take a look at the performance just over the last few days since the last video update. If you're not following along, make sure you hit that subscribe button down below. It helps out, following the channel, getting those latest updates. So you can see right over here, we are on the 1 day. So currently the last day was not so great. We had gains of negative $134.10. So obviously that's not a gain, that's a loss. But it's only a loss if we end up selling. So current value of the overall portfolio is actually down since the last video. It's at $15,957.16. If you are somewhat newer to investing, and you're seeing the downward trend from like day to day or like certain weeks, fear not. Honestly, for me personally, I love when the market's down. It sounds weird, but I tend to try to buy more because I can do what they call dollar cost averaging, or what people hear as DCA. So that's pretty popular for a lot of long-term investors such as myself, who are trying to build passive income with over $1,000 a month or whatever number is your main goal. Now, $1,000 is just kind of an arbitrary number. I think a lot of people like to hear about that and see that. So it is one of my goals, but obviously I have smaller, shorter goals in the intermediate future. So that way I can try to get myself excited about continuing to invest. So let's go ahead and take a look here. So for the week, we're actually up $74.02 on our gains right over there. Let's see where we're at for the month. So for the month, we're actually down $17.58 in total. And then if we go to the last quarter, we're up $856. So you can see this nice growth chart right here. Right there, it's really nice. And then over the last year, we're up $2,081.86. And I like to show this part for a lot of newer beginner investors. If you take a look here, back in November of 2019, I was at $885.25. I was starting off with like $10 a week. I think it was $10 a week is what I was doing. Then after a little while, as I got more comfortable, I started bumping it up to closer to $15 a week, then 20, then 30, 40, and then kind of kept moving up. And then when the market dropped in early 2020, I started investing a lot heavier, and then I just kind of kept going from there because I started feeling really comfortable with the process. So if you're getting started with just a couple $100s, don't be afraid. I think that's actually a great way to get started. If anybody makes fun of you for it, they are definitely not somebody you want to be around, because if you're only starting off with $10 a week, that's fine. Like, just make it happen, make it work, because over time, as you hopefully make more income or get more comfortable, you can start investing more like this, and you can just see month over month, time over time, you're just seeing this income going up. Not income, I should say, sorry. The value of the portfolio going up time after time. And there's dips here. You can see, it goes from 12,000, what was that? 12,800 to 12,400. And then over here hits 14,800, and then it drops all the way down to 14,100. So it goes up and down over time. And that's okay. But if long term it's constantly going up, that's where, we'd like to see it. Now, like I mentioned, I want to focus in on dividends, but I do have growth stocks as well too. But the dividends do get me really excited. I was talking to another content creator called Investing Sensei, and we were both talking about how our dividends actually get us really, really excited to be able to kind of, be enthralled with our investing journey, because it's one thing to see the value grow of a stock, but we don't get anything until we sell. Now, there are pros and cons for dividends, but here's some examples of like some of my latest dividends. Like AT&T, I got 13.10. NRZ, I got 754. Realty income, I got 247. So all this income right here as they come in gets me excited, gets me really, energetic to want to like keep on investing, get the dividend income, get the dividend increases, which nobody ever talks about, and we will here today. And then it just kind of keeps going from there. But obviously there's some downsides. You got to pay taxes on this stuff. So taxes, which is always, a fun thing. But taxes are a little bit different on dividends versus like regular income. So there are actually some pros on the tax side of things. But I mean, who likes to pay taxes regardless? It's never a fun thing. So regardless, I still get excited for it because, again, it gets me interested. And for anybody who's like, well, man, that looks really cool, $2 as a paycheck on the 30th from, Pepsi, and then another $1.95 from DLR on the 30th as well. That's right there, a little over $4 in income. But if we go all the way back to my beginning, we can see here with Microsoft, I got paid 2 cents. Then another company, ETF, I got paid out 64 cents. Then again, 3 cents from Microsoft. So it was very little amounts when it first got started. You could even see, if I scroll down here, like I got September of 2019, I was getting a nickel, 4 cents, 5 cents, again, 2 cents here back in September of 2019. But then when I look at September of 2020, you can just see that these are in like the $2, $1.77 range. So like you could see that increasing, and I'll show you my dividend spreadsheet here possibly in a second to kind of also see that. But the main goal is to get income coming in every single month. Now I have 28 holdings. So what this really does for me is it just kind of goes over the process of making sure that when I am getting paid, I'm not worried about getting paid every single month, like 5 times a month. Some companies pay me out, well, actually, every company pays me out every quarter except for Realty Income. This one pays me out every single month. So everything else is quarterly. There are 5 stocks in my portfolio that don't pay out any dividends right now, but everything else pays out quarterly. So I'm not sitting there trying to get it every single month, huge amounts. I just want to make sure that on a consistent basis, I have money coming in. My personal goal is to utilize this income that's going to be coming in, if I so chose to, for travel reasons in my 40s. That's going to be like the main goal for it. So what we're going to do is actually go to a website right over here. It's called marketbeat.com/dividends/calculator. And I already kind of filled some of this stuff out. I got a lot of stuff popped up for a second, so I had to reset that page. So right over here, you'll see it says dividend calculator. You can go to the website and plug in your information. It asks you what kind of portfolio or investing type. So I have it set as portfolio. Right over here, it's going to ask my starting principal. I just rounded it up to 16,000. This right over here, it says annual dividend yield. If you don't know what your dividend yield is, there's one of 2 ways you can do it. You could do the old-fashioned way by adding up all the dividend yields, dividing it by how many stocks are paying dividends. Or if you're an M1 Finance user, what you can do is click on research here towards the top, and then where it says my pies, you can click on here, and at the very bottom here, you'll see where it has like that little star on the circle. If you click on there, this will actually take you to your overall performance. This is not necessarily my actual performance, but this is kind of like a makeshift potential of what my performance would have been over the last, whatever amount of time. But what this does tell me is my current dividend yield. Now, this is also including stocks that are not paying out dividends, so I do have to take that kind of with a grain of salt when it comes to how much my dividend yield is. But technically speaking, the money that I'm depositing is getting split between those stocks that are not paying dividends. So something to be cautious about. So my yield is actually 2.034% as a total. We'll actually come back to this here in just a little bit, but let's go back to the dividend calculator. So I put that 2.034% in here. It asks if it's a taxable account. Of course, mine is, because it is. And then annual contribution, I'm just going to put $20,000 a year. This is estimated. My hope is to obviously do more, but based off of the trends I'm going, I think $20,000 is pretty reasonable for me to do every single year. And then this is probably one of my favorite things that nobody talks about ever is the annual dividend increases. A lot of companies that do pay out dividends do also increase their dividend year over year. Right now I have it at 8%, which is pretty okay, nothing too bad, but I'm going to also show you guys what it is with a little bit more because I figured out what my average is in just a moment. And then we're going to see the distribution frequency annually. With a lot of these, it's quarterly, so we're going to switch that to quarterly. And then the dividend tax rate, we're going to leave at 15%. Like I said, taxes on dividends are a little different. And then right over here, expected annual share price appreciation, I'm doing 8%. It's a little conservative. I can actually maybe do this at 10%. I feel a little confident with the 10%. And the reason for that is if I actually go back here, you can see right over here, like I talked about from earlier, this is a trajectory. If I actually had deposited $100 into this portfolio 5 years ago, where this would be. So the easiest thing I can do is I'm gonna just do this really simple. So 171.92% divided by 5 years. That's an average increase of 34%. But that's just depending on like the companies that you have in your portfolio. So average is 34% a year with the stocks that I have in this portfolio holding. But what I'm going to do is I'm just going to be super conservative and probably still leave it at the 10%. I'll be very conservative there. Then there's this right over here that says DRIP. If you don't know what DRIP stands for, that's okay. It stands for Dividend Reinvestment Program. A lot of companies have this, and if they don't, you can also potentially just reinvest the dividends yourself. So this is just taking money that you earn from dividend income and then reinvesting it back into your portfolio instead of keeping it out of the account. And doing so actually helps increase the amount of money you're going to be making year over year because it's helping you compound. And then we're going to just set it for 20 years, and we're going to go ahead and do the calculations here. So there's a couple pieces of information here, but the first thing that we want to do is actually, let me close all those off again, is actually go down here. And we're going to look for the annual dividends right over here. And you can see here right by around year 9. So in 9 years, I know it sounds like a long time, but I have a lot of other things going on as well too at the same time. But in 9 years, we're going to have $11,134.47 in annual dividends. Obviously, that's not $12,000, but I would suspect somewhere between year 9 and 10, I would hit that. And that means on an average, I would be making about $1,000 every single month. Some months higher, some months lower, but averaging out to that. But you can see here my principal would be about $291,000, and then you can see where's that the new balance right over here is going to be $350,235 in total right over there. So this is going to help me get to my balance there. A lot of that has to do with the dividend increase happening every single year, because if my dividend increases were lower than 8%, it would take longer. But like I said, I actually did the math on mine, and my average is like 10.5%. 10.5% dividend yield increase. So we're going to see how that changes this calculator right over here. So if I go back down here after doing that update, you're going to see here, that keeps popping up. So we're going to see right over here in year 9 now, it's actually $13,575. So between year 8 and 9, because of my actual dividend increases that have been averaged out, are actually going to be right over here to hit that over $12,000 a year in dividends, which would equate to about $1,000 a month. So that's really cool. And if you're curious how I got that number, what I ended up doing was going to seekingalpha.com. I have all my stocks kind of put together in a little portfolio. I clicked on the dividend tab, and then what I did was I did the dividend growth over the last 3 years average for each stock, added these all up together. So you could see all these. So I had some stocks paying me out an increase for the last 3 years on average 25%, which is crazy. I've had some stocks, increase their dividend by 13% on average, some at 9%, and then some as low as 2%. So I added that all together and then divided it up, and that's what gave me that 10.5%. And so that's what's giving me the opportunity within year 8 or 9, if I stuck to $20,000 a year, to get over $1,000 a month. Like I said, it might seem like a long time, but honestly, it is just a matter of being patient, being willing to put in the work and effort for it, because I also have other things that I'm going to try to save up for, like rental properties and other types of investments. So 20,000 I think is going to be pretty conservative for the long term, because maybe down in the next couple of years, if my pay increases, I'll probably invest more into the overall portfolio. But we'll see how that goes at the end. Now, if I did look at this after 20 years, by the way, my balance will be estimated to be about $2.7 million, with a total return of about 553%, averaging out to about 27% year over year. My annual dividend income right there totaled out would be $430,682 and a penny. which would be crazy. And then the total dividend payouts over 20 years would be over 1.1 million. So the reason for that is if you look, if we scroll all the way down here towards that 20 year, that's because my yield, if you see this right over here, my yield is going, well, I have an arrow pointing down, but technically my yield is going to be going up. So let me actually clear that off. So my yield is going up. So I started off here in the year 2020 with a 2.03% dividend. And so if all the companies stay consistent, which is not going to be the case, some companies are going to stop or slow down, but we might add new companies in that increase their dividend yield. And all of a sudden, over the next couple of decades, I'm going to be getting a 13.56% on my money because of the dividend yield increasing year over year. And that's effectively just giving me a raise. And if you're not too familiar with what that means, let me show you here really quick. Actually, let me go back to my main page here just to make sure it doesn't go away. So if we go back here, let's go to Home Depot, for example. So Home Depot, I have them in my portfolio. I love them. So if we go into their dividend tab here, and we're going to go to where they say dividend news. And what we're going to find out is the last time they did a dividend increase. So here, the news article says that they declared a dividend. So that's nothing different than before. Same thing, same thing. Down this one right over here, back in February of 2020, they actually increased their dividend by about 10.3%. So actually right on par with our average that we were estimating. And they went from $1.36, I should say, to $1.50. Now, that doesn't seem like a lot because it's just 14 cents. But if you already own shares of this company, if you were buying in over the last couple of years and they're increasing it and you have, let's say 100 shares or 1,000 shares of this company over time, that 14 cents really does add up. And that's like a 10% raise for doing absolutely nothing. Like you got a raise and you didn't have to do any extra work. Obviously, you may be done work in the front end like I do, or, maybe you're somebody who pays attention every day. Whatever the case may be, though, you got that 10% increase. And that, to me, is fantastic. Like, I absolutely love that. Now, keep in mind, this was in February 2020. We had a lot of downward trends, going on. But if we go back 1 year prior, so February of 2019, they had a 32% increase. They went from $1.03 to $1.36. Can you imagine getting a 36% raise at your job, but you didn't do anything different? Everything you did from then on out were the same things that you did before, but you just got a 32% raise. Like, to me, that is fantastic. That is amazing. And I think it's one thing that a lot of people don't talk about when it comes to trying to create dividend income is that it might not be the big thing now, but if I'm buying at a certain price point now, that as my dividends increase, my yield goes off the charts and goes to, that 13%, which one stock paying 13% would be outlandish right now just because that's so high risk. But because of the yields going up on average, my money is becoming essentially more valuable over time. And I know a lot of people say, well, in 10 years, $1,000 is not going to be worth that much. And, that's obviously true. Inflation does have an effect on your money. But if you're getting, 10, 15% increases on your dividends every single year, like you are with, Home Depot or a lot of these companies, you can see their 5-year average is 23%. You are going to keep your money pacing with inflation and surpassing it. I did mention that I had a stock. Let me actually go back here. So I had a stock that is barely keeping up with inflation here. So if I go here, so for example, like I have AT&T. So AT&T right now is paying a really solid dividend if you buy in at this current time because you're getting 7.4% on your money. But their 5-year average is 2.09%, which means it is barely keeping up with inflation. And that's not going to change this number overall for you long term because it's not, gaining anything year over year versus Home Depot, even though the yield is smaller because of that 20, 15, even 10% increase year over year, your yield is going to go up. And I know that might seem a little complex to some people, but if you really just kind of hone in on it and just kind of believe in that system for the long term, that's going to obviously yield you, pun intended, some really great results. And for me personally, I'm excited. If I wanted to, like I said, when I hit that, $1,000 a month, I can use that money for travel. Or if I just kept reinvesting it every single year, over year, I'm just going to be making money hand over fist. Can you imagine in 20 years, I'll be making $315,000 a year in annual dividends, What does that come out to every single month? Where's my calculator? There it is. So 315, 122, divided by 12. That's $26,260. Granted, you know, you got to count for inflation, but if I wanted to wait 20 years, so when I'm in my 50s, I can get $26,260 a month on average, you know, to be able to spend on whatever I want. That might be worth my time and effort to be investing now because it can equal out that. Now, obviously, there's no guarantees. With investing, there's not a guarantee that, you know, the projections that I put over here are going to come out on top or how I would expect them. Like I said, sometimes companies will, you know, do not so great. Like if we look at AT&T here, for example, you know, even though they are a pretty solid company to have, you could see their performance has been abysmal over the last 10 years. Like you're actually down 35%, or sorry, 0.35% if you bought 10 years ago. But obviously you got your yield on your dividend, but maybe not at the same yield that it is today. So, you know, is it worth it? Is it not worth it? You know, sometimes you're going to have to take the risk of making sure that with some stocks you keep them in. You keep them in your portfolio. Other ones you might have to move out. So there is going to be this constant, even though it's a passive way of investing, you're going to have to still pay attention to what is going on in your portfolio as well. So for me, 28 holdings in total right over here, equaling out that 2.034 dividend yield is going to hopefully equate to me earning quite a bit in dividends, you know, 10, 20 years down the road. Obviously, if I wanted to keep going further, I can, but that is compounding interest, and that's going to keep building up time and time again. Hopefully, you know, because right now, let me see if I have it right here. I can show you. So right now I have, like I said, 5 companies that don't pay me dividends, 4 of which are focused on growth, which are Tesla, Amazon, Google, and Facebook. So I don't expect dividends right now, but hey, who knows? Maybe in 5 years, or actually less than 5 years, you know, Facebook might start giving out dividends. Maybe in 10 years, Google will start paying out dividends. Maybe, you know, in 8, 9 years, Amazon will start paying out dividends. And maybe in like 50 years, Tesla will pay out dividends. Who knows? Maybe that's the case. Maybe that will be it. But if that ends up happening, that's great. You know, having the gains versus having the dividends, both are awesome. Obviously, I would want whatever gives me the most return long term, but I'm also hedging my bets, right? Instead of just doing all growth, I'm having growth and dividends, but I'm not just focusing on dividends, because there are some out there that when you like listen to them, they talk about the 4%. 4% dividend yield is great, but for me right now, since I'm not focused on that portion of it, I'm focused on the dividend growth. Obviously, like if I go back here to AT&T, the growth on this one's not great, but I've had them in my portfolio for a long time and I still like them. But, you know, somebody like Home Depot, or what was the next company that had like really good growth? Like AbbVie or Visa. Like Visa is a great example. Even though they pay a really low dividend yield of 0.6%, they're averaging 20% increase year over year. So even though I'm getting in at a low yield, I'm having some great, you know, results when it comes to the overall stock growth, but then also the dividend growth as well. The dividend increases on that are going to be awesome over time. So I'm going to keep focusing on those. I don't really care if it's a 4% yield or if it's a 2% yield, as long as the average 5 years is looking good, as long as the company can still pay out as well too, because I know I'm like switching back and forth here, but one thing you want to pay attention to if you are going to start paying attention to dividends is the payout ratio. This is something really important that you want to focus in on. So right now, Visa is paying out 23.55%, and anything above like 60 to 70 is starting to get really risky. Effectively, this is 23% of their profit is being paid out in dividends, so that's less for them to be able to reinvest in their company. 23% is super safe. Anything, like I said, above 60, 70% is getting really risky for companies. There are some exclusions, like REITs might be a little bit higher. REITs are those real estate stocks. So if you have something like Realty Income, which I do, those ones have a higher percentage over here, just because they're actually required to, by law, to pay out higher yields. Well, not higher yields, higher percentages of their profits, which equates to higher payout percentages. So if you're just getting started and caring about dividends, make sure you are paying attention to payout ratios, because you know, I've seen people who are like, oh my gosh, I see a company that has like 10% dividend yield and that's awesome and everything, but then their payout ratio is like 99% or even something above 99, because if anything is above 100%, what that means is the company's paying out profits from debt to be able to pay those dividends and keep them coming, which might sound stupid, but let me see if they let me see if they have this still. I never owned them, but I think BP at one point had like a crazy percentage. Yeah, it's not there anymore. Let's see if I can find out what their dividend percentage was. So yeah, when your dividend yield, or sorry, when your payout ratio is like off the charts, you're going into debt to be able to pay for those things, and that's not a good sign. You don't want to be doing that or wanting to get into a company that does that, just because that means they won't be able to pay for those dividends anymore and take cuts like BP did. And I'm trying to see if I can find, where is it? It's on a certain page here that'll tell me what their payout ratio was. So, no, it's not there. But nonetheless, nope, it's still not over there either. Maybe it's in the dividend safety. Here it is. Okay, so dividend safety, payout ratio. So you can see cash dividend payout ratio, 176%. Yeah, so this company right here was paying out payout ratios of 78%, getting close to 80%. And like I said, as you start getting closer to 100%, it makes it really tough. This company was getting over 200% and then all the way to over 786% for paying out any dividend, which means they were paying out almost like, what is that, like $8 in debt just to pay each share out or something like that. Something crazy, I think it was. But obviously they discontinued their dividend for now. They suspended it just because it was not feasible to continue to do that process. So keep in caution with that dividend yield, because long term, if the company's increasing it, it won't matter where it sits at when it gets started as far as being added to your portfolio. Now, this is my overall portfolio. Like I said, it's 171% over the last 5 years if I were to have invested 5 years ago and where it would be today. But the cool thing is with this M1 Finance, like I said, if you guys want to check it out, link will be down below. You can click on each section individually and see where their performance would be over the last 5 years. So like this would be 245% for my tech pie. And it also tells you what the dividend yield is for that particular pie too, which is really, really cool. Gives you a great understanding of like how that particular section is doing in your overall pie. So if we go back, we can go to our growth. Our growth has no dividend yield whatsoever, but you could see here the growth over 5 years is 455%. So that's obviously a huge chunk of where my average increases from my overall portfolios because of these companies. That'd be great to have invested 5 years ago. Financials, you could see here the growth on this is about 60%, even with the dip that happened in 2020. My dividend yield is 2.166%. If we go to retail, my overall performance is 111% if I had invested 5 years ago. Dividend yield is pretty low on this one. It's 1.358%. I think a lot of it has to do with Costco and the fact that Ross was my fifth company, if you were paying attention, is actually my fifth company that stopped, well, actually doesn't pay a dividend, but it actually stopped paying dividends because of the whole 2020 situation. Hopefully that company comes back with a dividend payout. It would be nice. And then if we look at our industries, so our industries is about 43% performance over the last 5 years. So that's a little under 10%. It's not great, but the nice thing is this is, I think, is a little skewed because this huge drop only happened because of a split with one of the stocks. If you don't know what that is, that's when a company cuts their price a little bit, so that way their stock price is a little bit cheaper looking, but effectively it doesn't change anything on the company. They just essentially add more shares out in the public. And that company was NEE that did that. So right over here, you can see the dividend yield is 2.117%. And then let's go to real estate. Real estate is pretty low here. It has gone down as far as my overall amount in my portfolio, but it's about 28%. It definitely has not recovered since the whole 2020 fiasco. But my yield on this is 5.65%. So this has definitely bumped up my average on that one across the board. This one over time is just going to be focused on buying in during downturns in the market and not buying in when the market is doing good, just because the yields on those don't increase very much. My consumer sector here has, over the last 5 years, on average, if I were to have invested, gone up about 50% over the last 5 years. So that's about 10% a year. The dividend yield on this one is 2.68%. And then right over here, my health sector is over the last 5 years, 43.85%. And you can see the dividend yield on this one is 3.714%. So even though some of these have higher dividend yields, their performance you can see has been kind of lower. And the ones that are more focused on growth and dividend increases are also the ones that have lower dividend yields but higher performance in the overall. So there's kind of like a win on one side, a little bit of a lose on the other. So having a nice balance for me personally is really nice. All these companies that have somewhat of a lower performance, if I go back to my main portfolio, I'll see here, those ones have much smaller targets on their actual pies or sectors, where all the ones that are doing very well performance-wise and dividend growth on some of these have much higher percentages in my overall portfolio. And so that is going to help me make sure that I'm kind of well-balanced, where I'm getting some really great growth, paying attention to dividends, and having all of that accumulate to be able to equal out to what we saw earlier, which was that this ends up happening and being the case in 20 years, if I'm still here on YouTube or any other platform, you guys can hopefully see that I'll end up with $2.717 million in here and making crazy amounts of dividends every single month to be able to either reinvest, spend on travel, or do anything else that I want to do, because that's why I'm focusing on this and that's why I'm paying attention. And hopefully you guys are doing that as well, because being consistent is what's going to get you through this process. It's whether you know what you're doing or whether you are trying to, figure things out, being consistent is going to be the key. You can see there, started off this portfolio in January of 2019 with $100, and then just slowly but surely grew and grew and grew, and it kept going up and it keeps going up. And right now we're sitting pretty much at $16,000. Hopefully it will continue to keep moving forward. Now, I do want to make sure that you are staying consistent in this process as well. So deposit every single week if you can. And then I want you to make sure you check out the next video to keep on learning and growing with your investing portfolio. My name is Dennis, and I will see you in that next video.